we're going to get into our last session for the afternoon. FBT season approaching us once again. What we're going to cover is a quick look at a review that the Board of Tax is undertaking or has been undertaking around the FBT system. We're going to have a look at a bit of an update in terms of the FBT motor vehicle exemption rules, some finalisation of some guidance from the ATO on that area. We're then going to focus on a couple of key issues, practical issues around FBT and making sure people have got things right. Things like employee contributions, otherwise deductible rule, minor benefits exemption. So those key things that often relying on to try and get rid of an FBT liability, but there are some tricks around each of those things. We want to make sure we're getting them right. The one I'm going to spend a bit of time focusing on is employee contributions. We've heard from a number of Knowledge Shop members of situations where they've had a lot of trouble with the ATO around the area of employee contributions and whether there's sufficient evidence to suggest that employee contributions have been effective, and they're finding quite difficult to convince the ATO that that is the case. We'll come back to that in just a bit. First of all, just to make you aware, the Board of Tax has been undertaking a review into the way the FBT system works. It's a review focused on compliance costs. So some of you may have seen a questionnaire that was circulated a little while back, late last year, where basically the Board of Tax put it out to businesses, accountants, said, look, where is FBT taking the most time? What are the things that are taking the most time? The Board of Tax's, I guess, aim out of this is to find out, well, where is all the time being spent, and are there ways that that might be fixed so that people aren't spending as much time as they are, particularly if there's not a whole lot of revenue being collected from these things anyway. So we'll see what comes out of that. The Board of Tax can't change the rules. They can make recommendations to government. We do find that government often does pick up on those recommendations. So we'll see what happens. But anyway, just wanted to very briefly let you know that we may see some improvement in the way the FBT system operates. But I would probably suggest don't hold your breath. Very quickly, what's the ATO looking at when it comes to FBT at the moment? Probably pretty similar to what they've been looking at for a while now. Motor vehicles, you'll find that's where a lot of ATO focus is. Are the motor vehicle exemptions being applied correctly? We'll focus on that in just a minute. As I mentioned earlier, employee contributions does seem to be an area where the ATO is probably, I'm seeing a bit more focus on that compared to what I've seen in the past. Some common mistakes, again, the ones that we see where people are getting tripped up, and the ATO notices that as well. Living away from home situations. Those rules changed quite significantly a while back. Still seeing people kind of taking aspects of the old rules and mixing them in with the new rules. So bit of a danger area, can be quite complex, so be aware that we need to work through those rules pretty carefully. Exempt entities, tax exempt entities, assuming that they're entitled to the FBT rebate or not knowing what the FBT rebate really is and thinking it's an FBT exemption, not a rebate. So again, where you've got exempt entities, again, they may not really understand how the FBT system applies to them. So maybe raising that at some point, making sure that they're actually complying with the rules, understand how the system applies to them might be a good idea. The other one is Christmas parties and gifts, entertainment sort of area. There's a range of exemptions that can apply. Often we can apply exemptions, but the ATO, again, just making sure that people are dealing with that correctly, but also ensuring there's consistent treatment with income tax system and the GST system as well. So you tend to find that where we're dealing with things like parties and other forms of entertainment, if it's not subject to FBT, it's generally pretty hard to get a deduction and GST credits. But if it is subject to FBT, we probably generally can claim deductions and GST credits. Just briefly, before we get into, I guess, specifics around the exempt motor vehicle rules, generally around the provision of motor vehicles. Clearly, the ATO is doing a lot more data matching than they used to. Systems are pretty sophisticated. It does seem that the ATO is able to identify things faster, with greater ease than what they've been able to in the past. So it certainly is an area to be very, very careful about. As well as possibly, again, having those conversations with clients to make sure they're actually on the right track when it comes to how they're dealing with the motor vehicles. Just a couple of practical things that might well be worth raising or suggesting. One thing is maybe a little bit more formality around agreements, and particularly when related parties are involved. The director who's using a car owned by the company, is there any formality? Is there anything documented in terms of how that arrangement's going to work? And we'll see in a bit later on, if there is no documentation at all, that's where things like employee contributions can be a little bit hard to kind of work through properly. So a little bit more formality, particularly for related party arrangements, certainly can help. The other thing is, again, what some people are trying to suggest to their clients is even where they think exempt motor vehicle benefits are being provided, even where they think the exemption is available, they're requiring that employees complete a logbook as a bit of a backup. So even if the exemption is not available, look, if we've got a logbook saying that it's 94% business use, that's a whole lot better than what it would otherwise be if we had no logbook and we're down to a statutory formula method, etc. The risk for FBT is always with the employer. It's the employer who cops it if something goes wrong. So if the employee has gone and used the vehicle in a different way to what they've told the employer, it's the employer who's going to wear the cost. So are there things maybe the employer could be doing to protect their position? And one thing might be requiring a logbook to be kept as a bit of a backup in case things go wrong. Well, let's spend a bit of time looking at this exempt motor vehicle issue. Raised this a couple of times over the last couple of years because the ATO has been, first of all, focusing on this area far more than they used to. And secondly, releasing some practical guidance around this. Now, this time last year, I think from memory, we might have raised this draft PCG, 2017 D14, which was applicable to the 2018 year. It was basically the ATO setting out some safe harbour guidance around the exempt motor vehicle rules. The ATO has finalised that, pretty similar, but with a couple of little twists to it. So PCG 2018-3 applies to the 2019, the current FBT year onwards, until the ATO decides to change that. And as I said, it's safe harbour guidance around the exempt motor vehicle rules. Now, before we get into, I guess, the final details of that PCG, let's just run through what do you need to do to qualify for the FBT exemption around motor vehicles. Two main aspects. First of all, it needs to be an eligible vehicle. Only some vehicles qualify for the exemption. If we have an eligible vehicle, we then have to look at the way it's being used. And basically, it needs to have very limited private use. The use of that vehicle needs to fall within certain categories. How do we know if it's an eligible vehicle? Well, starting point is just have a look whether it's a car. Is it a car as defined in the FBT system, which is pretty much the same as the income tax system? A motor vehicle is a car if designed to carry a load of less than 1 tonne and fewer than 9 passengers. So if it can carry a load of 1 tonne or more, then it's not a car. If it can carry 9 or more passengers, then it's not a car. Doesn't have to be able to do both. One or either of those is fine. So if we're dealing with a ute that can carry 1 tonne or more, then it's not a car. It will be an eligible vehicle. We then look at the way it's being used. If the vehicle is a car, and the sorts of things that might fall within that category are maybe utes that can't carry 1 tonne or more, might be dual cab utes, it might be 4-wheel drives, those sorts of things. We'd then have a look at whether they could still qualify for the exemption. We have to check whether it would fall within one of these categories. Is it a taxi, a panel van, or a single cab ute? If so, eligible vehicle. If it is not one of those things, we need to look at how it's been designed. Is it designed principally to carry passengers or not? If it is not designed principally to carry passengers, then it again should be an eligible vehicle and potentially qualify for the FBT exemption, again subject to how it's being used. How do we know if a vehicle is designed principally to carry passengers? Well, it depends on the type of vehicle. If it's a dual cab or crew cab ute, then we look at MT 2024, which basically says apply this formula and you'll get a yes or a no answer. The formula is basically looking at how the vehicle has been designed and its carrying capacity. We take the number of seats in the vehicle, multiply it by 68 kilograms. That gives us a number. We then compare that to the total carrying capacity of the vehicle. And we're just using that to determine whether most of the carrying capacity relates to the seats and what they can hold in terms of passengers. So we just apply that formula and we get a pretty black and white answer one way or the other. If the vehicle is not a dual cab or crew cab ute, and it's not already an eligible vehicle because it's within one of the other categories, it's probably going to be some sort of 4-wheel drive vehicle. In most cases, that's what we'll be dealing with here. In that case, we have to look at a different bit of ATO guidance, TD 94/19. And the ATO says there's a broader range of factors you need to look at. Look at that formula in terms of carrying capacity, but don't stop there. You also have to look at other relevant factors, which would include how the vehicle is marketed, specifications, features. Does it look like it's been designed as a work vehicle, or does it look like it's been designed as a recreational vehicle to carry passengers on holidays, etc.? And we need to make a call on that. So we can't just look at the formula in that case. It's a little bit harder. We've got to look at a couple of other things as well. So we work through a process to see whether the vehicle is an eligible vehicle and might potentially qualify for the exemption. If we do have an eligible vehicle that might qualify for the exemption, then we have to look at how it's used. In order to be exempt, it basically has to be, well, the idea behind the rules is that it needs to be used mainly for work purposes. We have 3 types of travel that are allowed. Travel directly between home and work, travel that is incidental to employment duties, or other non-work related travel that is minor, infrequent and irregular. And there's always going to be a grey around that last one especially. So if we have an eligible vehicle, it's not a car or it fits within one of those other categories, and the vehicle is only used to do those 3 types of travel, then the benefit should be exempt from FBT. Then we get to some common questions. First of all, a lot of people say, hang on, didn't the ATO used to do some of this for us? They used to provide a list of all these different vehicles and they told us whether they were eligible or not, and we just had to figure out how they got used. Unfortunately, the ATO got rid of that list a little while ago. They brought it back for a little while. They didn't update it, I don't think. They just kind of brought back what they had, and then they took it away again. And as far as I can tell, it's not there anymore. It's not like it's archived somewhere that you can find. It just seems to have been taken off the system. So unfortunately, the ATO doesn't do that for us anymore. We need to work through that process. Until something changes, please let me know if you've seen it somewhere. It would make everyone's life easier, but I certainly haven't come across it. Does the vehicle need to be related to the employee's work activities to qualify for the exemption? No. I'm assuming when the exemption was put in place back in probably 1986, salary packaging hadn't been invented yet. So the assumption was if you were being provided with a ute, you were probably being provided with a ute because you were going to use it in your work. That assumption is probably no longer valid, as we all know, but the rules haven't been changed to keep pace with that. So there is no requirement for you to use, or the employee to use, the vehicle in their work. There need not be any connection between the vehicle and their work activities. As long as the travel they're doing fits within one of those 3 categories, then it can still be exempt from FBT regardless of what they do for work. What records should be kept if we're looking at claiming the exemption? Well, records to show that it is an exempt vehicle, an eligible vehicle. Hopefully it won't be too difficult. Again, the risk is on the employer. So if we're relying on what the employee has told us, again, if the ATO looks at that in any sort of detail, maybe what the employee told us wasn't quite accurate, it's the employer who is going to wear the FBT liability. So what might be some things in terms of records and other steps that could be taken? Well, it may be, again, maybe the employer specifies that the employee, as a condition of receiving the vehicle, completes a logbook and provides a bit of a backup in case the ATO doesn't believe the exemption is available. It may be that the employer puts in place some sort of agreement whereby the employee agrees to indemnify the employer for any FBT if what they've told them just turns out to be challenged by the ATO. Keeping records of operating costs and the like, again, might just help if it turns out that you have to actually do an FBT calculation down the track. But there's no black and white list of what records need to be kept. It's up to the employer to justify the position they're taking and to prove that the exemption is actually available. Where the ATO has kind of stepped in to try and make that a little bit easier is with these PCGs, these practical compliance guidelines, safe harbour guidance. What the ATO said is, look, if you can meet the conditions set out in the PCG, then basically you're at much lower risk of being reviewed in terms of your application of the FBT exemption. But it's a pretty strict list of conditions. And if you've looked at this any time over the last year or so, see a lot of kind of typical client scenarios probably aren't going to fall within the scope of this PCG. Now, the thing is that even if these conditions aren't met, it doesn't mean the exemption's not available. It just means that you, again, are at higher risk. The employer is at higher risk that the ATO is going to disagree that the exemption actually is available in the first place. Let's have a quick look at the conditions that need to be met to qualify for this safe harbour ATO guidance. First thing is, it needs to be an eligible vehicle, so you still need to work through the process of looking at the vehicle and the type of vehicle that's involved, and it needs to be provided to a current employee, not a previous employee or a future employee or their spouse or other associate. It needs to be their current employee. It needs to be provided to them for use in their work activities. So there needs to be some connection between the vehicle and work duties. Now again, just because there's no connection doesn't mean the exemption's not available, it just means you can't rely on the ATO safe harbour. The GST inclusive value of the vehicle needs to be less than the luxury car tax threshold. Whether luxury car tax applies or not isn't the question, it's just is the cost less than the threshold or not. There must be no salary sacrifice arrangement in place around the provision of that vehicle. So if the vehicle has been provided under a salary sacrifice arrangement where the employee has agreed to give up some of the remuneration they would otherwise receive in return for the use of the vehicle, then you don't get to rely on the PCG. And you're just back to having to prove your position under the normal exemption rules. There must be an employer policy limiting private use. So the employer needs to have a written policy that says, we're providing you with the use of this vehicle, but you're only allowed to use it for these things. The employer then must take reasonable steps to monitor private use. Now this is where this version is a bit different to the draft version that was issued a year or so ago. The older version, the ATO said that reasonable steps meant actually asking for things like odometer records on a regular basis and comparing that to what you think the employee would have been driving to and from work, etc., and kind of checking it that way. What the ATO says now in this version for the 2019 FBT year onwards is it's okay just to seek assurance from the employee. So send them an email at the end of the FBT year and say, look, we provided you with this benefit, remind you of what the policy is, can you please confirm in writing that you have complied with our policy? You get an email back from the employee that says, of course I did, I'm all good. The ATO says that's what those reasonable steps are these days. We then need to make sure that private use is restricted. Practical guidance, I guess, again from the ATO in terms of what is acceptable use of the vehicle. Direct travel between home and work is okay. That's what the rules say anyway, so that's okay. The ATO says if someone makes a diversion on their way to and from work and that diversion adds no more than 2 kilometres to the normal length of the trip, that's okay. So they go and pick up newspaper or something, pick something up on the way through to work. If that doesn't add more than 2 kilometres to the trip, then that's okay. We're then allowed some minor, infrequent and irregular private use. The ATO says, in order to qualify for the safe harbour, there must be no more than 1,000 kilometres worth of that sort of travel in the FBT year. And no single return journey must exceed 200 kilometres in terms of private travel. They're not very big thresholds. So once again, just because the employee has used that vehicle to travel 1,002 kilometres during the FBT year doesn't mean the exemption doesn't apply, it just means you can't rely on the safe harbour. There's a higher expectation on the employer in terms of making sure that the exemption is available. There's a higher risk that the ATO will review it and ask for some evidence to prove that the exemption is available. And again, in that case, you'd think, again, maybe more important for the employer to take some extra steps to protect their position, logbooks and the like, to make sure they've got a bit of a backup in case... Sorry, say that again? Yeah, and that's what the ATO is getting at. You've got a policy that says you can't do more than this, and you get an email from the employee saying, yep, I only did that or I did less than that. Now the thing is, I think the ATO does say it needs to be reasonable to accept that assurance. How do you know it's reasonable to accept that assurance without giving some thought to what they've actually done? Again, if I was the employer and I wanted to be careful around this because it's my exposure, you might ask for the employee to provide, and it might be a condition of the benefit, that they give you the odometer records for the year. And you just quickly type into Google Maps how far it is from their home to work each day, you multiply it by 200, and if the number's roughly the same, that might be a little bit more reasonable to rely on as well. Again, a practical step from the employer to show that you can rely on what the employee's told you. But if you stick those numbers in and they're double what the employee's told you, then probably less reasonable to rely on that assurance. Okay, let's move on from that. We're going to focus on employee contributions. As I said, we're seeing a bit of ATO activity in this area. I just want to cover off some really key points. So, fringe benefits being provided. Let's assume it's not exempt from FBT for whatever reason, and we're trying to ensure that the taxable value is reduced, maybe to nil, because the employee has made some recipient's payments or employee contributions towards the benefit. Now, in order for those contributions to be taken into account, there are some key conditions that need to be met. First of all, that contribution has to be out of after-tax income. So that distinction between salary sacrifice and employee contributions. Salary sacrifice is pre-tax. It is not an after-tax contribution. It's not an employee contribution. After-tax employee contributions are what we're talking about here. So very big difference between salary sacrifice and employee contributions. The ATO says in its guidance around employee contributions that an employee contribution is only effective for FBT purposes if it is made with respect to a particular and specific benefit that is being provided. A contribution that someone makes to a car fringe benefit can't then be reallocated as a contribution towards some other fringe benefit. So a practical example might be car fringe benefits being provided and some after-tax employee contributions are being made, and it's just getting sorted out through payroll each month. So amounts being taken out after tax towards this fringe benefit. But it turns out that the contributions being made across the FBT year are actually more than the taxable value of the benefit. So we've got an excess amount. The ATO says you can't just reallocate that excess to other fringe benefits that are being provided to the employee, unless there's something to show that that is a contribution towards that other fringe benefit. If it's just a bit of surplus excess contribution, it can't be reallocated to other benefits. What can you do with it? You can carry it forward. The ATO says you could carry it forward into next year against that same benefit, or you could refund it to the employee and kind of just wash things out a bit. But you can't just reallocate. So there does need to be a link between the contribution and a specific benefit. Now, this is where lack of documentation and formality can be a bit of a downfall, because if there is no link between those two things, there's no salary sacrifice agreement or other agreement which simply sets out that contributions are being made towards this benefit, no emails, no nothing, then there's a chance that the ATO are going to take a bit of an issue with that. Next thing we need to look at is timing. When does an employee contribution need to be made in order for it to be effective for FBT purposes? There's actually not specific rules around that. So a contribution made after the FBT year has concluded could still be effective as an employee contribution and reduce taxable value and FBT liability. Potentially it could be made after the FBT return has been lodged. So it's not necessarily when the contribution is made that's important. What the ATO focuses on is, was there a pre-existing obligation to make that contribution? As long as the obligation was there before the end of the FBT year, the fact that there might be a bit of tidying up done after the end of the FBT year is not such a big deal. But can we prove that there was an obligation? Again, if there is no documentation and absolutely no formality around the arrangement, then contributions made when accounts are being prepared or when FBT returns are being done, there's very big risk that the ATO challenge that. And that's where we've seen some people getting a bit unstuck lately. We've seen situations where the ATO has come in and said, look, we can see that you've treated these things as employee contributions, but we cannot see any evidence that there was a pre-existing obligation to make that contribution towards that benefit. And it probably could have been fixed with a piece of paper that said, this benefit is being provided to you, you agree that you'll make sufficient contributions to eliminate the taxable value each year, something along those lines. Doesn't necessarily need to say much. Accounting records could potentially help you with that. So if you can show through accounting records that the two parties had agreed that this contribution would be made, But again, we look at timing around that. When were those accounting entries put in place? If it's too late, that won't help. I wouldn't want to rely just on that either. It might help you, it might get you there, but on its own is still a little bit risky. Some sort of salary sacrifice agreement would certainly help with that, just that little bit of formality around it, confirming that there's an obligation. For those of you who are looking for something that might help you with that, Knowledge Shop member website, in the knowledge area, there are some pro forma salary sacrifice agreements. Look, they're not meant to be the final product, but there's some wording there that might be useful as a starting point. I think there might be one for car fringe benefits, maybe a couple other ones as well. There's 2 or 3 on there, just pro formas that maybe you could kind of help with, that could be used to help clients. Just put a little bit of formality around those arrangements, particularly around employee contributions, particularly for things like related parties, where it's the director using the car. Is there any evidence that they've agreed to make these employee contributions? If not, the risk is there. Now, where do you find the ATO's guidance on this? In a ruling? In a guide on the ATO website? No, you don't find it in any of those places. You have to dig through some NTLG meeting minutes from about 12 years ago. And that's where you might find some ATO comments on this. If you want to find those minutes, let me know. I'll dig them out for you and send them through. But it's not the best way for the ATO to provide guidance to us, hidden in some meeting minutes from 12 years ago. But that's kind of what the ATO is saying. Yeah, just a question. Yep. We will actually come back to journal entries. Do you want to just maybe hold off and we'll just see? I might answer your question anyway. But yeah, that's a common issue, so we'll come back to that. So timing-wise, not so much a problem about when it's made, it's the obligation. Is there an obligation to make the contribution? For income tax purposes, there's flow-on implications. Contributions made to the employer would normally be treated as income of the employer. So the ATO will look to see whether there's consistency in treatment. You've reduced the taxable value for FBT purposes, but are you actually also including it as income for the employer? Contributions made to a third party shouldn't be treated as income of the employer. So it might be where the employee has gone and paid some petrol for their novated car. They haven't been reimbursed. The contribution has been made by paying the petrol costs to the service station. That doesn't need to be recorded as income of the employer, but where contributions have been made to the employer in respect of a benefit, it should be treated as income. Question we've been getting a little bit over the last little while is, what about these new corporate tax rate rules? What if we've got a company that's providing fringe benefits to staff and employee contributions are being made? How do those contributions get treated if we're trying to figure out what the tax rate is for that company and what the franking rate is? At a very high level, it depends on what the contribution is being made for, but I suspect in most cases it will be treated as base rate entity passive income. So treated as passive income when we're working through that 80% test to determine corporate tax rate. The reason for that is probably the most common benefit where we see employee contributions being made is cars and other motor vehicles. Base rate entity passive income is defined in a very specific way. It includes things like rent, interest, dividends, certain dividends. It includes royalties. The ATO has said that the term royalties takes its ordinary meaning, but it also has an expanded definition in the tax system. And there's a ruling, a really old ruling, that's certainly around long before these rules, that says that payments for the use of things like plant and equipment and other assets are treated as royalties for tax purposes. So based on that, it does seem to be an employee contribution towards a car fringe benefit, payment to use the car is probably going to be a royalty, probably base rate entity passive income for the 80% test. Now, does that make any difference? It may not, depending on the mix of passive versus non-passive income. For some companies, it may well make quite a difference. Where employee contributions aren't being made in cash but are being set off against salary and wages, where that's being on an after-tax basis, the employee still has to recognise that income for tax purposes on their tax return, should be showing up on their payment summaries. PAYG withholding would generally apply, super guarantee often will apply as well. So just because they're not receiving cash and then paying cash back, if it's being done through set-off after tax, we need to remember it's after tax. There's still tax to pay on that, and the employer still has obligations to meet. Just briefly, GST. Again, common question we get is, if an employee contribution is being made towards the provision of a fringe benefit, and that triggers a GST liability for the employer, what amount do we use to reduce the taxable value of the benefit? Is it the full amount, or is it the after GST amount? The ATO makes it clear that it is the full contribution, regardless of the fact that some of that might end up going to the ATO as GST. So when an employee contribution is made, if the employer is registered for GST, then in many cases that will trigger a GST liability because the employee is providing consideration for the provision of the benefit that they've received. Now, there would be some exceptions to that. If they're paying for the use of residential accommodation, it's probably an input tax supplier, so there probably is no GST liability in many cases along those lines. But if it's things like a car, then typically there will be a GST liability. But the ATO says the full amount of the contribution reduces the taxable value, even though some of that ends up going to the ATO as GST. So, very quick example. Let's say we've got ABC Proprietary Limited, provides Ben with a car fringe benefit. The taxable value of the benefit prior to any employee contribution is $7,000. Ben has paid $5,500 to the employer as an after-tax employee contribution. Ben has also paid $1,500 in petrol and other running costs and hasn't been reimbursed for those. So, what's the impact for FBT, income tax and GST purposes? So, FBT, taxable value of the benefit is $7,000. There's an employee contribution being made. It's being made in two different forms, but both of those we can add together. The fact that some of that employee contribution that Ben is making to the company might end up going to the ATO as GST, doesn't matter. Taxable value in this case should be reduced to nil. So $5,500, even though some of that's going to go to the ATO, GST probably, we still reduce the taxable value by that full amount. The $1,500 paid to third party for running costs in this case can also be treated as our employee contribution. So we should be able to get rid of the FBT liability. The $5,500 that Ben pays to the company, if that company is registered for GST, provision of a car fringe benefit, it's probably going to trigger a GST liability. So the company's going to pay some GST to the ATO. The company is probably also claiming back a whole bunch of GST credits on expenses relating to that car. The company would then be assessed on the net amount. So after GST has been paid, the net amount gets included in the company's assessable income, and it may then have some tax to pay on that. The amount that Ben has paid to the service station for petrol is still treated as an FBT employee contribution, but doesn't trigger GST for the employer and isn't income of the employer either. So the way the contribution is made doesn't necessarily change the way the FBT rules work, but it will change the way the income tax and GST rules work. Okay, getting on to the question around journal entries. So employee contributions by way of journal entries, the ATO says, yep, it can be done. Just need to be a little bit careful about how we do it. Now again, there is an ATO ruling that deals quite specifically with this area. And what the ATO runs through is what are the key things that need to be in place to ensure that those journal entries basically are an effective employee contribution. Three main conditions. First of all, the employee has to have an obligation to make a contribution towards a fringe benefit. It would certainly help if there is a bit of paper somewhere that says they have that obligation. That will help. The employer must have an obligation to make some sort of payment to the employee. So it might be some accrued salary or bonus or something that the company or the employer is obliged to pay to the employee. The third thing is the parties then need to agree to set off those obligations. They say, look, you owe me some money, I owe you some money in terms of that employee contribution. Let's just set those two liabilities off against each other so we don't have to give cash back and forth. And the journal entries are then used to record and document that arrangement, that transaction. It is up to the employer, if asked, to prove that the employee had an obligation to make the contribution. Go back to that issue I raised a bit earlier, some of the problems we've seen people having when they've kind of had ATO reviews being undertaken. The ATO has been focusing on, was the employee obliged to make a payment, and what obligation did the employer have to make some sort of payment to the employee? Because if there's no accrued salary or wages or other amounts, what obligation is there to make a payment to the employee? Well, the ATO says it could be that the employer has agreed to lend money to the employee. So just because there's no existing liability, they can create a liability to provide a loan. And then the loan is set off against the employee contribution. If there's a loan account set up in the accounts and there's accounting entries around that documenting that, the ATO says that's generally evidence that the employee has agreed to lend an amount to the employee. Again, I probably wouldn't want to leave it only at that if possible. Hopefully it will help you out if you need it. But if you go a step beyond just that accounting entry, that would probably be best. The trick with that is, of course, that if the employer has agreed to lend money to an employee, and they've then basically given that straight back again as an employee contribution, that outstanding loan could trigger follow-on issues. We might now have a loan fringe benefit that we need to deal with for FBT purposes. There could be a Division 7A issue that we'd need to manage. So by trying to fix the FBT problem, we might then be creating a second FBT problem or a Division 7A problem. Now, how do we know whether Division 7A or FBT applies? We start with Division 7A. When it comes to loans, Division 7A takes precedence. Is the loan being made to someone who's a shareholder of the company or an associate of a shareholder? If so, we're into Division 7A territory and we deal with it under the Division 7A provisions. If the recipient of the loan is not a shareholder and is not an associate of a shareholder, then we're into the FBT loan fringe benefit rules. And FBT implications will depend on interest that's being charged on that loan, how frequently interest is being charged on that loan, etc. But just be aware of that. Yes, the ATO acknowledges that employee contributions could potentially be made through journal entries. Just be a little bit careful about the process. Again, documentation around that, and also flow-on implications, particularly if we're creating new loans. Okay, so that's employee contributions. After-tax employee contributions. Let's just quickly look at the other way people often deal with FBT, which is implementing some sort of salary sacrifice arrangement. Salary sacrifice arrangement has no bearing on FBT. The employee agrees to give up some of their salary. That has no impact on the FBT calculations. The salary sacrifice arrangement is really just an arrangement between the employer and the employee, typically to ensure that the employer is not out of pocket. Typically, the salary sacrifice arrangement is being done to make sure that the employer is no worse off. So the employer is going to give this different type of benefit, and the employee typically is going to agree to take less salary. So we're trying normally to even things up a bit. Not always, but that's typically what the aim is. The agreement to be effective, and I guess why do we want it to be effective? Because if it's not effective, then the employee will still get taxed on the salary that they think that they've given up, and they'll be taxed at whatever their marginal rate is. So if we want to make sure that arrangement is effective and they're not being taxed on what they think they've given up, we need to make sure that an arrangement, an agreement is in place before they have an entitlement to the income that they've sacrificed. Now that doesn't mean they have to give it up before they receive it. Employment income is normally derived and taxable for tax purposes when it's actually received. The ATO says it's probably some earlier point than that. So we're looking at not before they receive it so much, but before they earn the entitlement, which might be a fair bit earlier. And that would depend on the type of income that's being given up, whether it's salary or bonuses, leave entitlements, those sorts of things. We need to make sure that we've got the timing right around that. We're giving it up early enough. Then again, if you've got clients who are looking at using salary sacrifice arrangements with their employees, again, thinking about documentation around that. We're protecting the employer's position there. Things like, is there a requirement or an obligation in that salary sacrifice agreement around employee contributions? If so, do they basically have to pay full contributions to get rid of the FBT liability? How will that be done? A lump sum at the end of the year? Will it be taken out throughout the year on a monthly basis? Whatever it is. Again, a bit of clarity around that is generally helpful. What will happen around super contributions? Natalie raised an issue earlier about salary sacrifice super, and that then reducing an employer's obligations to make SG contributions. And we've got some legislation potentially that's going to kind of resolve that issue. But that's only for salary sacrifice super as far as I'm aware. Other benefits that are salary sacrificed. You're an employee and you enter into a salary sacrifice arrangement, you agree to give up some of your salary in return for the use of a car. Well, your salary is reduced. That means the employer's obligation to make SG contributions has reduced as well. So are the parties actually aware of that? Is there an agreement between the parties to basically have super contributions being made on the total package value, not just the cash salary amount? Again, that's useful to clarify up front, because when the question gets asked later on, when the employee figures out that they're not getting as much super as they thought, having that in an agreement up front would certainly be helpful. What happens if the employee leaves or they're fired? What happens to the salary sacrifice arrangement that's in place? Again, a good salary sacrifice agreement will talk about what happens. What is it that will bring the arrangement to the end? What happens when the arrangement comes to an end? As I mentioned earlier, salary sacrifice arrangements, if they're effective, just means the employee will get taxed on less salary. It won't impact on the taxable value of the FBT calculation for FBT purposes. The employer would have a lower, salary amount, but they're probably spending money somewhere else in the provision of the benefit. So as I said, the salary sacrifice arrangement is often all about evening things up to make sure the employer is no worse off than they would be had they just paid straight salary. Lower PAYG withholding obligations, and as I mentioned a minute ago, generally lower super guarantee obligations too. For the employee, they're going to pay less tax, presumably, because they will have less taxable income, they've received less salary. They're receiving this other benefit instead. Now, when it comes to salary packaging arrangements, particularly around things like motor vehicles, often the best outcome for everyone will be a mixture between some salary sacrifice, some pre-tax salary sacrifice, and some after-tax employee contributions. The tricky bit is just working through a few different scenarios and calculations, so we basically end up with the structure that gives the employee the best after-tax outcome, but without it really costing anything extra to the employer. And that's where, I guess, we come in to try and figure out where that position is, the mix between the employee contribution and the salary sacrifice. At some point, there'll be an optimal mix between those two things. It's just a matter of kind of working through a few scenarios. Okay, a few other key issues I want to cover off before we wrap things up. The otherwise deductible rule. A lot of you would have come across the otherwise deductible rule. The whole point of it is to make sure that FBT doesn't apply to the extent that the employee would have been able to claim a deduction anyway for the benefit they've received. But there's a few really key things to keep in mind when we're trying to apply the otherwise deductible rule, and a couple of practical problems as well. First of all, the expense in question must be immediately deductible. If the employee would not have been able to claim an immediate deduction for that expense, then the otherwise deductible rule probably won't apply. So an expense that is deductible but spread over a number of years won't generally qualify for the otherwise deductible rule. It's got to be an upfront deduction. The recipient of the benefit has to be an employee. Again, this catches people out a little bit. If a fringe benefit is provided to an employee's spouse or other related party, still falls within the scope of the FBT rules in most cases. But the otherwise deductible rule is limited to benefits provided directly to an employee. So if a benefit's been provided to the employee's spouse, the fact that they would have been able to claim a deduction for that expense, for example, doesn't help. The otherwise deductible rule can't apply in that case. Where benefits are provided jointly to an employee and an associate, so let's assume we're dealing with someone and their spouse, there were some changes a few years ago to the way that the otherwise deductible rules apply. Previously, what the rule said was if a benefit was provided jointly to an employee and their associate, their spouse, for example, the benefit was deemed to be provided solely to the employee. So as long as then the employee would have been able to claim a deduction for that expense, then the otherwise deductible rule could potentially apply to the full benefit. However, some changes were made that basically say now that we don't apply that anymore. When it comes to the otherwise deductible rule, if a benefit is provided jointly to an employee and an associate, such as their spouse, we actually have to split that up into basically two types of benefits. Some of it relates to the employee, and the otherwise deductible rule can potentially apply to their share, but it can't apply to the extent that the benefit also relates to their spouse. So, change that was made, it's going back a few years ago, but again, just be a little bit careful around jointly provided benefits. The most common example we've seen on that is jointly owned rental properties, where jointly owned rental properties, people are salary sacrificing some of the rental property expenses. Just beware, because there may be FBT on some of the costs. The otherwise deductible rule can be useful in terms of giving the employee basically the benefit of a GST credit. So the expense may well have been deductible to the employee had they just gone and paid it themselves, but as an employee they probably wouldn't be able to claim back any of the GST on that expense. But if it's structured through a salary packaging arrangement, the employer will typically be able to claim back the GST, subject to the type of expense we're talking about. And if we can apply the otherwise deductible rule in full, then there should be no FBT liability. So you can basically then have the employer pass on some or all of that benefit of the GST credit to the employee. Also, just be a little bit careful around the application of the non-commercial loss rules. Now, there's a bit of an issue, there was a bit of a question mark over this for a while in terms of how we apply the otherwise deductible rule to people who might have business expenses. So you might have someone who's an employee, but they also carry on their own business. Would they be able to salary package their business expenses, and can we apply the otherwise deductible rule? And I guess the question really was, could you get around the non-commercial loss rules? The ATO's answer on that, not surprisingly perhaps, is no, you can't. When you're applying the otherwise deductible rule, we're looking at, would the employee have been able to claim a deduction for that expense? The ATO says you have to hypothetically impose the non-commercial loss rules over that. So would they be able to claim a deduction this year for that expense if the non-commercial loss rules were actually in application? If not, well, you can't avoid the application of those rules by salary packaging it and getting it done through the FBT system instead. Let's have a look at a couple of practical examples of where sometimes the rules don't go quite to plan. We don't quite get the outcome we want. So let's say we've got a company who's maybe looking at some options around employee shares, employee equity interests. The company is willing to lend some money to an employee to enable them to acquire shares. So, borrowed money is being used to acquire some shares in the company. How do we know whether, I guess, the interest on that loan will qualify for the otherwise deductible rule? Well, we typically look at, would the employee be able to claim a deduction for the interest? We'd have to look at, have those borrowed funds been used for income producing purposes? So we'd probably need to make some assessment about the likelihood of receiving taxable dividends from those shares. If the employee reasonably expects they're going to receive taxable dividends from owning those shares, then the otherwise deductible rule is probably going to apply. But if we twist that a little bit, what if the employee doesn't actually receive shares? What if they receive options that they can then exercise and convert into shares, maybe now, maybe later down the track? Well, you don't receive dividends from owning options. You've got to exercise the options, convert them into shares, and then you might have an entitlement to receive dividends. So if the employee is receiving options instead of shares, the otherwise deductible rule probably won't apply in that case to the interest. What if the company says, look, we're willing to lend you this money, we don't actually care if you hold the shares personally, or if you have them held by your wife, or by your family trust or related company? What if the shares then end up being issued to some related party and the loan is provided to that party to subscribe for the shares? The otherwise deductible rule apply? No, it doesn't, because the benefit is not being provided to the employee. It's being provided to their associate. So again, we just need to be very careful about the specifics of the rules. Yes, there is that reduction that might apply, but we need to just make sure that the relevant conditions are being met. A couple of the other practical issues we see around the otherwise deductible rule. For example, clients who might run their business through a discretionary family trust. They don't receive a salary, they just receive trust distributions each year. But they're spending money personally relating to the work that they do for the business. The otherwise deductible rule, very difficult to apply in a case like that. Expenses that would have been incurred maybe at the individual level. What link is there with assessable income? Well, if it's just a discretionary trust distribution, there is probably not a sufficient link. So it would be very hard to apply the otherwise deductible rule in a case like that. If that individual was also receiving some taxable salary, that could potentially change things. But someone who is not receiving any employment income, only receiving discretionary distributions from, say, a trust, it is going to be very, very difficult to ever apply the otherwise deductible rule in respect of benefits provided to them. Similar problem arises sometimes when people basically salary sacrifice all of their income. So they're only receiving fringe benefits. Again, depending on the type of benefits we're talking about, if we're looking to apply the otherwise deductible rule, well, if they're not receiving any taxable salary, very difficult to apply the otherwise deductible rule. So sometimes the way that people's remuneration is structured, again, typically when we're dealing with related party type arrangements, can make it difficult to get access to things like the otherwise deductible rule. Just very briefly, car expenses. When car expenses are being reimbursed or paid for by an employer, we're not dealing with a car fringe benefit situation. Just be aware there are two very specific ways we need to apply the otherwise deductible rule. Either we use the logbook method, but that needs or requires the employee to have kept a valid logbook, and we use the logbook to determine the deductible percentage or the otherwise deductible percentage. If there is no logbook, we don't want to use that method, then we can base the otherwise deductible rule off a employee declaration. But the maximum business use percentage we can use from an employee declaration is 33 1/3%. So again, one of the potential problem areas of employees not having kept a logbook is, again, it might be a flow-on impact back to the employer in terms of a greater FBT liability than would otherwise maybe apply. Briefly on the minor benefits rule, again, I just want to pick up on the minor benefits rule, given a lot of people are looking to apply that this time of year especially. Some things to make sure we keep in mind. Remember that the minor benefits exemption is only available if the value of the benefit is less than $300. So a number of questions we get through where people are giving their staff members $300 gift vouchers, assuming that it's all exempt. Not exempt because the value is not less than $300. So it has to be less than $300. Exactly $300, you don't get the exemption. It has to be less than $300. The ATO says you cannot apply that exemption to salary sacrifice benefits. So the ATO's ruling around the benefits exemption says basically if it appears that the employee has given up any of their salary in return for these small benefits, you can't apply this exemption. Yep, just a question up there. Yeah, so it's the value of the benefit for FBT purposes, yeah. Now, can you apply the minor benefits rule when the benefit is provided to an associate? Yes, you can. So the otherwise deductible rule, we've said the benefit has to be provided to the employee. If it's provided to an associate, you don't get to apply the otherwise deductible rule. Minor benefits rule is a bit more flexible. Benefits provided to an employee, their associates, potentially all can apply. We can apply that exemption potentially to all those benefits. So there's a little bit more flexibility in that. Just because the value of the benefit is less than $300 does not necessarily mean that the benefit is exempt. There are a list of factors we then need to work through. So less than $300 is our starting point, but we then have to look at, is this benefit provided on an infrequent and a regular basis? That isn't enough to look at. We have to look at the value of associated or similar benefits being provided during the year, the practical difficulty in respect of dealing with the FBT implications around these benefits that are being provided, the circumstances, is it a one-off thing, is it a performance thing, how likely is it that those performance hurdles will be met? They're the sorts of factors the ATO tells us we need to take into account when applying the minor benefits rule. Question that always comes up is how frequent is okay, or how regular is okay, where's the dividing line? There is no dividing line. It'd be nice if there was. There is a bit of guidance from the ATO in terms of what might qualify one way or the other, but you tend to find, like lots of ATO examples, that it's pretty extreme. You provide a one-off benefit to someone on their birthday, it's probably exempt. You provide it 300 times during the year, it's probably not exempt. But what about where do we get in the middle? Now, I had heard, or I read somewhere at one point, that the ATO was working on some safe harbour guidelines around the minor benefits rules. A little bit like those exempt motor vehicle benefits we talked about earlier, some sort of safe harbour guidance. Look, if you meet these conditions, we'll kind of leave you alone. Yeah, I understood that the ATO was trying to come up with something around the minor benefits rule, just hopefully some practical guidelines so we don't have to waste time worrying about this too much. I certainly haven't seen anything being released. I don't know if it's still part of the ATO's plans, but we'll certainly keep you up to date, because if something does come out, it would be pretty useful, I would imagine. If you want more guidance on the minor benefits exemption, there is a ruling, TR 2007/12. A whole bunch of examples. Look, whether they are helpful to you or not probably depends. But yes, there is some guidance from the ATO. It's a pretty detailed ruling. So if you're struggling through whether something's exempt or not under that exemption, have a look at the ruling. You may well find an example that's kind of close enough to your situation. If it's not, well, you're going to have to make a call on it one way or the other based on some of these factors. I guess we get asked a fair bit, look, is there any point bothering with salary packaging anymore? The government certainly has done a pretty good job over the years of getting rid of a lot of the packaging opportunities that were once in the system. But there are still certainly areas where packaging can be very, very worthwhile and worth exploring. I think car fringe benefits is still an area where a whole bunch of people can get some benefit. Low income earners, medium income earners, high income earners, there are people across the spectrum who can get a benefit from car packaging. It just needs someone to work through some numbers and see what they get out of it. Is it worth the hassle? So certainly keep that in mind, again, for clients who are just thinking, what can I do to pay a bit less tax? That might be something worth looking at. Exempt benefits. There are a whole bunch of exempt benefits. And again, they're worth exploring. Clients who are relocating or employees who are relocating, living away from home, there are some incredibly generous FBT exemptions that can apply when someone is having to move home because of work. And in some cases, those exemptions apply to situations that a lot of people wouldn't think they'd be available. But we need to make sure we work through those rules pretty carefully. Some very strict conditions that need to be met. Expats coming to Australia for work, again, there's a bunch of exemptions and concessions around kind of transport costs getting to Australia, visa costs, other costs relating to their arrival here in Australia. Again, there's exemptions that potentially are worth looking at. Religious practitioners still generally exempt from FBT as long as they fall within certain kind of categories. Exempt employers, again, got clients who are working for exempt employers, want to make sure that their position is being reviewed, just to make sure they're absolutely maximising what they can receive under their exempt benefit caps. Yep. Yep. Yeah. So the question was basically, if you are employed by multiple exempt employers, FBT exempt employers, can you double up on the caps? Yeah, definitely. You can triple up, quadruple up. Yep. So there will be clients, doctors, who work maybe for multiple hospitals. Potentially can take full benefit of multiple caps. Yeah. Need to make sure it's separate employers. It might be someone who's changed employers through the year, gone from one hospital to another. Again, you can get the full cap for both during that 1 year. Again, you can double up within a year. So again, there's opportunities there. We just want to make sure that they're not being missed out on. Just be careful though, when we're obviously working through any opportunities, we're working through the calculations carefully. Again, where I see generally where kind of people fall down, where clients are finding themselves in trouble, it's just lack of documentation. I mean, that probably goes for everything, doesn't it, in tax? It's lack of records, lack of formality, it's often people's downfall. It does seem that there is some focus from the ATO in this area. As I said, employee contributions seems to be the one we're seeing a bit at the moment. So keep that in mind when you're having discussions with clients, particularly around motor vehicles and the like. Bit of formality early on might save some pretty major headaches later down the track. And of course, it's the employer who's going to wear it if something goes wrong. So again, onus is on the employer to make sure that they've done what they need to do to make sure things are compliant, or put in place something that forces the employee to take some extra steps to try and protect the employer's position. Okay, so that's FBT. As I said, no major changes to the system this year. A little bit of guidance here and there from the ATO. There's certainly some focus from the ATO in certain areas. Beyond that, largely business as usual when it comes to the FBT system. Rightio. that's it for today. Thank you very much. Thank you very much for coming. If you could fill out feedback forms, leave them on your desks. We'll collate those up. Leave your name tags. We'll recycle those as well. Look forward to seeing you all over the next little while at webinars, full workshop days, and the Knowledge Shop conference. Don't forget to have a look into that. And see you all again very shortly. Thanks, everyone.